In this video, I'm going to try and help you avoid a very dangerous stock market investing habit that I see a lot of people doing these days. As you can see, we're going to be going through a very high level, kind of 10,000 foot view of my personal investing process. My name is Matthew, and I've been investing for a few years, which in the grand scheme of things is not very long, but definitely long enough for me to be able to hopefully share some valuable lessons and lessons that I've had to learn the hard way, oftentimes by losing a good chunk of money. So hopefully I can help you avoid doing that. Now, if you guys find this video valuable, please do let me know in the comments. Smash that like button, of course, and subscribe if I'm able to earn it by the value you receive in this video. So let's see if that happens. This is the investing path that I would say most investors go through. Okay, so I'm working on my iPad now here, trying out this new format. So you discover the stock, right? Oftentimes this could be, maybe you discover a new company that's expanding into your neighborhood and you see they're growing rather fast, so you want to look into them. Great. That's a great way to discover companies, is in your everyday life. Maybe you see a headline, right, of a new company that has had a breakthrough in technology, or maybe a new SPAC merger. SPAC market's kind of rough right now, but maybe a few months ago, that was how a lot of people found out about new companies. And then after that, you look into their story. You see, okay, what is this company about? What are they doing? And this is often where a lot of people stop their due diligence, their research process, and they just say, okay, this is a really cool company. I think the field they're in is the future, for example, EVs, and I'm going to buy the stock so I can invest in it. And the underlying kind of idea behind that, I guess, is not necessarily wrong, right? You want to find trends that are going to be big in the future and invest in them now. However, the danger of doing this, I guess, what I would call headline investing, is that you don't get to dig into these other areas, their fundamentals and their valuation. So this right here is an example. Oops, sorry. This right here is an example, right? New spaceship company will be used for interplanetary travel by 2025. Buzz Aldrin is on the board. So oftentimes on the board. This is supposed to be this is supposed to be but oftentimes people will kind of see like buzzwords, no pun intended, with Buzz Aldrin, haha, super funny. But they'll see like a big name they recognize, combine it with a very exciting industry, right? And then they'll say, boom, I'm going to invest in that. But that is what I would consider headline investing. And it's dangerous because you can have, and this is important, you can have a really great company and you can love this company and they can be running a fantastic business model. But a good company does not mean it's a good stock. And that's because the stock can be disconnected from the fundamentals. And that's often, for example, when it's extremely overvalued, right? Or sometimes if you don't dig into the fundamentals, the business model and stuff like that, say it's not a perfect business, there could be risks that you're not aware of that could be very, very prevalent and that could harm your investment. So as an investor, you should always be looking at, yes, the upside, but also what can go wrong with this investment, because investing is very much about risk reward, protecting that downside just as much as you're focusing on that upside. So next, you want to look into their business model, right? What is their revenue? What are their earnings? How do they make money? You want to understand what are the different ways this business makes money, because again, I can guarantee you, I can name some companies that some people, they don't actually know how they make money. Like what is the name of their product, right? You could probably tell me, oh, they make money from the EV sector. Oh, they make money from data collection. But what is their product? What does it do, right? What is their total addressable? Oops, didn't mean to erase that. What is their total addressable market, or their TAM? How big can this company grow into? What or who is their moat and competition? Is it scalable? Now, obviously, this is not comprehensive, but if you want to pause this video, take a screenshot or something, these are some really great starter questions when looking into their business. So for example, the reason why I say, you want to, of course, look at their revenue and their earnings. Is their revenue going up? Is it an upward momentum? Is it a growth company? Are they continuing to grow? But also, a lot of companies are pre-revenue, especially in the SPAC world, right? There's a lot of pre-revenue companies, one of them being Arrival. And Arrival, their valuation was actually so shocking to me that I had to make a video on them. When they were in the mid-20s, they were still called CIIC, and I made this about 4 months ago when I think it was in the mid-20s or high $20 range. They were a pre-revenue company that was valued in the tens of billions of dollars. Now, there's another argument to be made, right? a lot of people talk about Tesla. They say, yeah, Tesla's valuation didn't make sense either. But the thing is, right? You can have a company, again, that you love, but maybe right now, at this point in time, it is not a strong risk reward investment, right? Down the road, maybe 5 years from now, when Arrival, or 3 years from now, when Arrival has a lot of products on the road, a lot of sales, boom. Yeah, that's a great time to maybe buy into the company if it's trading at a decent level. But sometimes there's also opportunity costs that you have to factor into your investments, right? If it's trading at a rich valuation right now, it's probably either going to stagnate or drop in the next couple of years or so, and you can just get in at a better price. So yeah, one red flag here is pre-revenue companies. A lot of it is going to be their story, and a lot of it's going to be projections, and management has to execute to a T flawlessly to meet a lot of these projections. Because again, I mean, with SPACs in particular, they're trying to sell you on the company. They're trying to get you to invest. So it's always good to kind of go into things with a skeptical eye. Where are they getting this data? I'll make another video maybe. But sometimes I annotate 10Ks, and I really emphasize you got to read the footnotes whenever I send those annotated 10Ks to the people in my Discord. But I've made similar moves, right? I'll give you an example of a time that I should have been careful. Is when I invested in Virgin Galactic, ticker SPCE, in the mid $16 range. And I really should have sold it in February when it was at like $60 a share, and that was a big mistake on my part, because Virgin Galactic, although they do have some revenue, their core business is not up and running yet, which is space tourism. And I mean, you could have treated it like a pre-revenue company. There was no business for them to be trading at $60 a share, so I should have sold at that point. So next, you want to look at their financials. I won't go too in depth on this because this is like, you can make 3 different videos on this, and this is what we're learning every week, also in the Discord with the mentor lessons. But that's not what I'm here to talk about. So really quickly, you want to look at balance sheet health, right? What is their debt to cash ratio? Do they have a lot of long-term debt and not a lot of cash? If so, that's going to be kind of a burden for the company. I personally love to find companies with lots of cash, low debt, really strong balance sheets, and that's like the bare minimum, at least for me. And then income statement. Again, going back to that revenue growth, profitability. And for me as a growth investor, a lot of the companies I look into are not yet profitable, but do they have a path to profitability? Are their margins expanding? Meaning, are their margins getting better and better? And then you can look at their cash flow statement. Are they cash flow positive? What's their free cash flow look like? Are they allocating capital responsibly? So once you've got that, you want to look at the valuation. And sometimes I actually do this first. Sometimes this is a way for me to screen through different companies, because if a company is trading at a certain valuation that is just really ridiculous, I don't necessarily want to put in all of this work just to say, oh, this is a stock I would never really buy at these levels. But at the same time, if you do this work first and then look at the valuation and say, oh, it's too high, well, now when the company does get back down to a more reasonable valuation that you want to buy at, you've already done this all this work. You just have to brush up a little bit on your thesis. Is everything still the same? Then boom, you can pull the trigger a lot easier than someone who has to start from scratch. So there are pros and cons to doing all this work before the valuation, and there's pros and cons to doing all this work, or doing the valuation first, if that makes sense. Okay, so when it comes to valuation, there's a lot of ways you can value companies. On the most basic level, you can look at their ratios, like their price to sales rate. I just did a video, actually, I'll put it up here, about kind of looking at price to sales ratios. Also PE, EV to revenue, EV to EBITDA, price to free cash flow, price to book. And then you can also make a comps table and compare the company's ratios and valuation to its peers and the rest of the industry. Also with ratios, you want to look at historical levels. And then you can also make models, right? You can make a DCF, or a discounted cash flow model, to find intrinsic value. You can look at financial statement models and make your own projections on these companies. But to do that, you really got to know the company pretty well. And then here's 2 examples, right? So this is a chart of the PS ratio, price to sales ratio for Square. And the reason I picked Square is actually, one as an example, because you can see, in the past, this is where Square's price to sales has previously traded at. In late 2018, it was trading at about maybe 15 or 14, a price to sales of 15 or 14. And today it's trading at a price to sales of about 12 or 13. But the reason why I picked Square in particular as well is because in my last video, which you just saw pop up here, I did use Square as an example, but something that others pointed out to me in the comments, which is very important, is that Square's revenue is kind of inflated right now because of the way they track their Bitcoin revenue. So I wanted to make that clarification for the last video. This price sales ratio for the core business of Square is actually probably a little more expensive because they're counting a lot of Bitcoin revenue that really has extremely almost break even margins. And I've actually made a video about Square, or one of my portfolio reveals. I talk about that, so let's not spend too much time on it there, but I did want to point it out. And then this is an example of a comps table. So this is where you take companies that are in the same industry. So right here, I'm focusing on Maxer Technologies. So Maxer is a stock that I hold in my portfolio. I've held it for a while, started buying in the mid-teens. And I compared it to other satellite players and defense contractors and stuff like that. So you take a look at their market cap, their total enterprise value, and then this is their price to sales, EV to sales, EV to EBITDA, PE, price to earnings, and price to book, right? And then what you do is you can look at the high, the mean, the median, and the low. And this is all stuff, I took these numbers from just Yahoo Finance statistics, and usually I would want to go calculate these myself. I'd want to find what is their EBITDA, what is their revenue, and then do the actual manual calculation myself. But for the sake of the example, I just pulled it out of Yahoo Finance. And this gives you an idea, right? Comparing it to your peers. Is this stock relatively fairly valued? Is it undervalued compared to the rest of the peers? Is it overvalued compared to the rest of the peers? And this can give you kind of more confidence in the way you value your company. But at the same time, you also want to take into account other things that are not on here, such as revenue growth rate. If Maxer, it's not growing at 20%, but say Maxer is growing at 20% and the other companies on this list here are all growing at 3%, then Maxer deserves to be trading at a higher multiple, at a premium. So lastly, to finish off this video, I want to talk about technical analysis. And I know this is a bit controversial for a lot of long-term investors. I'm primarily a long-term investor. But the reason why I like using technical analysis is because it can help with better exits and entries in your long-term position. So for example, right, I always start with the fundamentals as we just saw. And if I can find a price target based on fundamentals of say $50 per share for some stock, right? Whether I use a ratio to find this number or I use a DCF, then if I look at the chart, then technical analysis can kind of back me up on that, right? So if I see that, oh, whoops, didn't mean to do that. So if I see, okay, maybe the stock's trading like this, and then the stock is right here at this peak. And this is when I'm doing my research, right? This right here is when I'm doing my research, and that's when I find this price target of $50. But I see, okay, the technical analysis says maybe it can come back down to this previous resistance and it'll act as support. And guess what? It just happens to be at $50. So maybe I can get a better deal there. And that's exactly where my fundamental analysis says I should be entering this stock. Now, obviously, it doesn't always work out this way, but sometimes this can help in technical analysis, help you, just get that extra few percentage points on those entries and exits. Another time you can use this is maybe you think that the stock should be a fair value of $70 and now it's trading at 100 and it just took a parabolic move. Well, you could say, okay, if it starts to break below this point, there's pretty much no levels of previous support or resistance, and it's a clear shot back down to 60. So it's over. I already think it's overvalued. The TA says there's a lot of room to fall right past 70. So maybe I exit here, right? So It's controversial. I'm still learning TA myself, but I think it's a great tool to add to your tool belt as a well-rounded investor. So I hope you guys appreciate this video. Make sure to follow me on Instagram for daily posts about my portfolio, stocks I'm watching, and all that good stuff. Check out the quote of the day. You might just learn something. And if you did find anything valuable in this video, make sure to hit that subscribe button, like button, all that good stuff. And if you're watching at this point in the video, you are the real MVP. Don't forget your peace and thank yous.